Okay, guys, now let's take a look at the trade for Monday, May 4th. And this is a good example that shows how we rotate back over to directional trading after deploying a neutral structured trade on Friday. And again, by simply looking at the slope of the 200 SMA on a 5-minute chart for the previous session. So if we look back at Friday, May 1st, the slope is very much to the upside, and if we look at the difference between the open and close, it is nearly 50 points, which is well over the threshold that determines whether or not we are flattening out. So as we look at Monday morning, and we're coming into this Monday morning, we know that we are now trading directionally. We know that we have directional bias to the upside as well. This trade is also going to be a good opportunity to talk about the clearance guideline that I have in place for directional trading. So when we're looking for directional setup, we are actually going to not be trading the first 2 hours of the trade sessions. As we approach 10:30 Central Standard Time, we can start to look for any valid directional setups, which we do actually get yesterday right at 10:30. You can see here stochastic RSI is in the oversold threshold, which is what we want to see if our directional bias is to the upside. We have a crossover of the fast and slow moving average for stochastic RSI, and that lines up with a signal candle, which is simply when the close is higher than the open on a 5-minute candle. That is, again, if our directional bias is to the upside. So we do have a valid setup. It's right at 10:30. I mentioned the clearance guideline though. So this is just a guideline that is going to allow for us to have enough room for the trade to play out, and it is regarding a few levels, and those 3 levels are I mentioned the first hour range. I talked about the first hour range a little bit yesterday, so it's going to be the high and low of the first hour range, as well as the gap fill level. Okay, these levels are going to function as support or resistance, and especially the gap fill level, and the more significant the gap, the more significant the support or resistance. And I don't require them to function as support and resistance along with our trade setup. And that, if we're looking to set up a long trade, I don't need or require any of these levels to function as support. And if I'm looking to set up a short trade, I'm not looking for any of these levels to function as resistance, right? I simply just don't want them to be in the way of our trade. And the way to ensure that that happens is we need a defined value. So I've put into place a way that is a method that is adaptive and scalable. So we're simply going to use the expected move at the time of the trade entry, and we're going to use actually only half or 50% of the expected move. So if you're not familiar with the expected move, it's simply a forecast related to implied volatility. You can find it on your options chain for your brokerage. Most of them have it there. But at the time of this potential setup, the expected move was at 32 points. So half of that value would be 16 points that we would require before seeing one of these levels in the way. But as you can see here, the low of the first hour range was at 72.15. So this trade was the current price at that time was around 72.06. That's only 9 points, so that's not the required amount of room that we need. So I did not actually enter the trade there. I held off for a little bit. We did get another signal candle, but still not enough room. And while the setup was still valid, we did get another green candle, and it was down here at around 71.98 or so that I went ahead and put on the put credit spread. Okay, a 5-wide put credit spread, the 7200, 71.95. And if I look back yesterday, I did get that signal out at 10:54 Central Standard Time. We did sell that spread for 225. So 10:54 would have been, looks like the last minute of this candle here. Okay, so price did push against us for the next 15 or 20 minutes, actually pretty significantly. I thought it was a goner, but it did in fact reclaim that position, kind of move sideways, a little down, a little to the upside, but pretty much sideways for the remainder of the session. In fact, it was actually pretty exciting all the way up until the last minute. We weren't sure if we were going to take home a winner or not. But this is a good example how if we did not use that clearance guideline, we would have likely entered a position right here. And I'm entering at the money 5 wide spreads on these low volatility directional plays. So the spread would have been at least 5 points higher around here. So given that this trade barely won actually by less than a point, this would have likely been a loser if we had not held off and entered the trade a little bit later, which made good sense. While one of these levels might not have gotten in the way of the trade, we had just left the first hour range. We had just broke out the bottom of the first hour range, and it just is not a good time to enter the trade actually until we kind of gathered ourselves a little bit. And even when I did enter the trade, it's still obviously, as you saw, the price pushed down some more, but I was just following the mechanics of the trade system, and but we did in fact bring home a winner there. So that is that is Monday, May 4th, directional trade, a put credit spread that we took for a full win. We actually did close this out at I did buy it back at $20. So if we sold it for $225, that was a $205 profit on that trade yesterday. So that's the trade recap for Monday, May 4th, a directional low volatility at the money 5 wide credit spread that we took for a full win. So stay tuned for more of these videos, like I said, you guys, and give me a like and a subscribe if you can. That would help, and I'll see you guys in the next video.